Welcome, everyone, to the Daniel Krug and Associates Market Webinar for August 2025. Today, we're going to be talking about the market. I'll give you an update where we're at year to date, and also talk a little bit about qualified charitable distributions. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in today's presentation. We want to thank our portfolio research groups that are behind the scenes giving us a lot of information and providing the materials that we're presenting today, specific for today's City National Rockdale. Let's jump into where we're at in the economy and looking at our speedometers. We show these every month. If you're familiar with them, great. If not, I'll give you a little idea what we're talking about here. We have 25 leading economic indicators that we track on a monthly basis, and we represent how they're doing based off of the color of the dial. Green means it's positive, moving in a positive trend. Yellow means it's kind of neutral, not positive nor negative. And red means it's negative. So when you look at our leading economic indicators for August, you notice we've highlighted 3 of the dials. On the top row, we've highlighted U.S. economic outlook and consumer sentiment, and on the second row, interest rates. And what you'll notice is that the gray dial, which represented the gray needle that represents last month versus the black part of the needle, which represents this month, those 3 that I've highlighted are all moving a little bit to the right. We still don't consider it in a positive or green trend yet, but it's moving in the right direction.
Does that mean they're moving more Republican or what? Just going to the right? You're not talking about politics,
I'm not talking about politics.
Oh, okay. All right.
So I am talking about the economy, though. And what we're looking at here is, we've been in a time where this economy, Dan, has been slowing throughout the year, but I think we're kind of seeing this bottom out. We don't believe we're going into a recession. And by some of these yellow dials starting to move to the right towards the green means that, maybe we're coming to that bottom and we'll start seeing more positive trends in the economy moving forward.
Well, that's a true statement. I mean, the reality is consumer sentiment is driven a lot by what people are hearing, right? And when they start hearing that the outlook is looking better, then they feel better.
Right.
So that kind of makes sense there. And then as far as interest rates, it's getting better. I mean, no one has seen this huge push, but it is improving, and that's a big plus.
Yeah, I think that the tariff situation, looking back at April, put a little bit of a shock into the market, and people, were concerned.
Yeah.
But that's kind of going away, and I think we're starting to see that in some of the economic trends now.
Yeah, and that makes sense because a lot of the deals are being made between the countries, so there's really less news effectively, and for businesses, they have a better idea of what's coming down the road and how they need to adjust to it. So, All right, well, let's go ahead and move on here. I am going to start talking a little bit here about valuations. So most people, many people, if you're watching the market, the concern is, are valuations for these companies too high? Are we really getting ripe for a major pullback? And I would say to that question, it's a yes and a no. And maybe leaning more on a no as far as high valuations. If you take a look at this chart and you look at the upper right-hand chart where you've got the 5 blue bars, the first bar you're seeing, the biggest one, highest valuation of 40.6, is the 7 tech titans. And if you have been watching the markets at all this week, you'll see that there is a pretty good pullback on the NASDAQ and those 7 tech titans right now. But they're sitting at 40.6. And if you look at a lot of the research out there and you listen to a lot of the money managers, they're saying there's still room to grow there, even though the valuations are at 40.6, just because of the potential for those companies. If you go down the line, the S&P 500 X 7 tech titans. It's sitting at about 19.4, which that might be a little bit edging to the higher side. But I think more importantly is where the equal weighted is, and that's the fourth bar over to from the left to the right, is the equal weighted S&P 500, which is sitting at 16.9. That is not a really high valuation, especially when you look at that center bar, which is the S&P 500 15-year average, is sitting at 16.8. So, all in all, no, I don't think the overall market is oversold at this point. The valuations aren't really high. And you can even go to the last bar on here, which is the Dow dividend stocks, which is at 12.1, which realistically is kind of low. So I think we've got a lot of running room relative to valuations and the forward-looking PE multiples that we see. So all in all, that is good. The chart below, the colored chart, really gives you the history going back to 1995 relative to where the S&P 500 forward price earnings ratio has been over time. And, this last decade, I guess, maybe 2 decades, it's been a little on the high side, but nothing out of control. I'm going to now look at the S&P 500 earnings growth forecast. And this is where the consensus is really kind of saying that it's going to be sitting right around 9.1%, which is really a healthy earnings growth forecast for the S&P 500 as a whole. You look at the blue chart, and this is where City National Rockdale actually kind of breaks it down a little bit, but their total is looking at about 7.5%. Again, not bad at all. It's growth. It's something that the analysts are looking at and saying, again, there is some running room here in this market. Now, looking at the economic forecast, you guys have all seen this chart before. City National puts this out really on a monthly basis. And if you watched us in June, you would see that the consensus and the numbers had just not changed at all. And that's not a bad thing because the overall consensus, the overall real annual GDP growth, the corporate profit growth, the CPI year end, all these are looking healthy. So when you look at the real GDP growth and where it's going, I would say we don't really know exactly, but we do know that the current administration has a very pro-business approach. That's very good for business growth and profits. And I think we're going in the right direction there.
My 2 takeaways from that, when you're looking at, hey, are we going to be able to make money in the stock market is dependent on, first of all, our company's growing.
Yeah.
So we showed that both earnings are showing that we're going to be growing earnings and also, more importantly, profits.
Yeah.
Profit growth is still out there. So you want to own stocks when the companies are growing and they're making money. So we're pretty bullish about where we see things right now, even though the economy has been slowing from the beginning of the year till now.
Yeah, it's so funny because they talk about it slowing, but if you look at things from an average over time, this is not a bad economy we have right now.
No.
It just is not. It's actually a favorable economy. So let's go ahead and move on.
Sounds good. Let me talk a little bit with everybody about the markets year to date, just so we know where we're at. We're showing here the S&P 500 capital weight index is up 8.79% year to date, while the equal weighted S&P 500 is up 5.65. The Dow 30, which is the 30 largest companies in the United States, up are 5.24%, while the NASDAQ is up double digit, 10.72 here in August. One of the things I want to point out is the difference between the capital weighted and the equal weighted. Remember, we've told you the capital weighted includes some of these NASDAQ companies because the big tech titans are in the capital weighted. They're portion of the S&P index is a higher percentage than the smaller companies. So that's kind of influencing the higher return of the capital weighted versus the equal weighted. As we go down into the mid-sized companies and the small companies in the U.S., represented by the Russell 300 and the Russell 2000, or Russell 3000 and the Russell 2000, those two indexes are lagging behind the large cap stock companies, but they still are given a decent return year to date, including that is the U.S. bond market, which is up about 2% year to date. So when we go back and look at the last few years, the bond market has really been a negative. It's finally kind of turned around and starting to stabilize, and we're starting to see positive returns out of the bond market, which plays well for those blended portfolios. Another thing I wanted to talk about before we get to September is something that we call the September effect. So what is the September effect? When you look at the historical month-by-month returns of the stock market, the S&P 500 generally has its worst month in September. Why is that? Well, some of the theories out there are, during the summer, everybody's busy. They've got vacations, trips, weddings, you name it. Things are going on. People are busy, and they kind of lose track of their portfolio. They're not paying that much attention to it. So now when September rolls around, the kids are back in school, you're going, oh, I need to relook at my investments. So, they start making adjustments based off of not looking at it over the last 2 or 3 months and seeing what's changing in the markets. Also, many companies that do quarterly rebalancing, those are done in September. So there's a lot of buying and selling due to that. Also, advisors like us start their tax loss harvesting season. This is where we look at, where are stocks really doing well, where we might have some losses, and how can we offset those? So that generates a lot of additional buying and selling. Then there's the behavioral bias. A lot of people know that the September effect is widely known. So they're thinking, well, if the market's going to go down, why not sell now and buy back in later in October? Companies also do a little bit of corporate profit taking because their fiscal year ends in September, and they want to claim that on their books for the year. So that corporate profit taking takes place. And also they have their quarterly earnings reports coming out, which could be either a positive or negative, Dan, depending on what they're forecasting for their earnings for the balance of the year. And finally, consumer spending tends to slow down. We tend to spend more in the summer due to vacations and, like I said, weddings and graduations and all those things that we do in the summer. So that has a big impact as companies tend to see less sales in September. But for us, this means a potential buying opportunity. We want to take advantage of those market downturns because we know they're short-lived and reposition portfolios for our clients going into the fourth quarter.
Well, it's funny when you talk about the bias, and I would say this: we don't jump out of the market just because a month traditionally is low, right? Because the reality is if the month is down 60% of the time, there's also 40% of the time that it is up, and you just can't guess which is going to be. And then you also have what I would say would be the Trump effect. You never know what Trump's going to do, so you don't know how it's going to affect the market. So it's out there, but it is an interesting tidbit there.
You get some peace in Russia and Ukraine, some settlement there. That's going to be a positive. So, but the point is that, we watch it.
Yep.
We know this statistic. And
absolutely.
If it's a good time to say, hey, let's sell something that's, not move as fast as something else and replace it with something we think is going to do better, we're doing that. So we're watching the portfolio on your behalf.
Well, and that's the great thing about tactically managing portfolios. You have that flexibility to do it. And that's what we're all about here. Let's go ahead and go on to the next area here. And I'm just going to do a quick tax mitigation tip of the month is qualified charitable distributions, or commonly known as QCDs. So what is a qualified charitable distribution? Well, it's an IRA withdrawal that is paid directly from your IRA to a qualified charity. So you're not going to take a withdrawal and then give the money to, let's say, your church. You would actually have the custodian make a check out directly from the IRA to that charity, and then you could give them the check, and that would qualify as the proper distribution. And while income tax is normally due on each traditional IRA distribution, the account owner does not need to pay taxes on the amount transferred to the charity. This is by far the most economical way to do a charitable gift out to a company, a charity that you have. And we do this all the time with our clients. And most of you watching this might say, yep, I do that. Well, this is something that we kind of strive for clients to use because it really reduces the taxes for them. And we have systems in place that will allow us to accommodate whatever method you want to be distributing to your charity. Let's go on to a little bit more detail. How do you meet the QCD requirements? Well, first of all, the IRA owner must be age 70 and a half or older. So this is not for everybody. Those who meet the age requirement can transfer up to $100,000 per year. Only IRA accounts are eligible. So if you have a 401k, a 403b, a simple, a SEP, you cannot do it from there. You would have to roll it over to an IRA before it would be eligible. Next, it must be made by December 31st each year. It's not like your contributions to your IRA or Roth IRA where you can wait all the way up to April 15th. This has to be done by December 31st of each year. You don't need to itemize your taxes in order to make an IRA charitable distribution. Matter of fact, it doesn't even come on the front page of your tax return. And then finally, you are not getting taxed on this money, so you cannot get to count, or you do not get to count it as a charitable deduction. Now, the interesting thing here is with the new tax laws, you get, and I can't remember with it, whether it's an extra $1,000 or $2,000 that you can actually write off as a charitable deduction,
right,
even if you don't itemize.
Correct.
So this is on top of that. This is in addition to.
Right.
So that's really it. It's a lot of good information. I hope we didn't take too long on this.
Yeah.
Do you have any last comments?
Just the only thing I'd like to add on that is you mentioned the $1,000 or $2,000 additional tax write-off you get. Do that with things, that you can give away, like clothing or furniture. Do those kind of deductions to the Salvation Army, get the write-off, and then you do your QCD from your IRA,
Absolutely.
And you get the benefit from both of those.
Absolutely. That makes a lot of sense. All right, so let's go ahead and close this up. Again, you can go to our YouTube channel. The best way to get there is just go to our website at mydkna.com. Click on Watch Us. Then you click on DKNA YouTube, and it'll take you directly to our site. And again, there's a wealth of information there. We've got a bunch of snackables. So if you only have a few minutes, snackables are great to get information from. Or if you'd like to see the whole reel, you can do that as well. And again, there's no need to worry. You take care of yourself. We're ready for 2025 and beyond.
Have a great day, everybody.
Bye-bye.